Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
David Bianco of DWS looking ahead to next year and writing this line. While a recession is not the base case, risks of overheating and macroeconomic uncertainty remain. David joins us now for more. David, good morning.
Good morning.
Let's talk about that risk of overheating. How very real is that risk for next year?
Well, the economy likely stays strong. I don't think it accelerates because things have been good, and it probably stays at about 2.5% GDP growth. It's inflation being sticky. Particularly because of services, that's a risk. So that's perhaps an overheating risk. The other thing is excessive fiscal spending. Now that's why with Besant markets, not just markets, the equity side has been very excited about Trump ever since the win, but this is good news for the bond market. The Secretary of Treasury to come is concerned about the deficit, so that's welcome news. And the message of 333, that's good messaging so far.
So let's get to the 333. 3% growth, right. 3% deficit. And I think also it's 3 million barrels a day of oil equivalents, not just oil equivalents. And I think that's a really important point. Do you think that can be met? Do you think that can be achieved?
Right. So 3% real GDP growth is within reach for the U.S. economy with the right balance of things like tariffs versus deregulation and lower taxes. 3 million barrels over a few years' time, additional to the about 14 million. I would argue that's well within reach, but that would hurt profits, but it's within reach. Now, the 3% deficit, that's out of reach. But I'm glad he's reaching for it and pointing to it, and I think the bond market's excited to hear Secretary of Treasury being concerned about these deficits.
How do you translate ideas and a muddied set of signals from some of the cabinet members who have gotten selected? Scott Bessent catering to the market-friendly crowd, others catering to the vaccine skeptic crowd, others possibly talking about ripping up the Justice Department. How do you put this together to understand whether you need to change your forecast for next year, whether Washington is just going to basically tamp down any extremes and keep things the way they are?
Well, it's still early on. We're still learning so much about these policies, but I'm a markets guy. Bessent's a markets person, so we're feeling good today. But this is an environment where who's to say where these policies are going to go and the right mix and balance of them and how other countries in the world respond to our policies, particularly things like tariffs. It's still a risky geopolitical world, so on one hand, oil prices might go down because of domestic supply, but that's still under geopolitical threat. So our forecasts need to be flexible, and markets are likely going to be volatile over the coming year, but probably still upward.
Was this Treasury Secretary pick, though, really crucial when it comes to pinning the Treasury market in particular, sort of pinning bond yields with somebody at the helm who is going to be very trained on what exactly the markets say?
Well, the candidates were all good candidates. So, I don't think there was alarm in this area, but I do think that this is a selection that people like myself say, this makes sense. This is a thoughtful person and experience with markets. And one of the things that Secretary of Treasury does is help deal with problems, particularly problems in markets, problems with funding. Keeping confidence in the U.S. bond market is an important thing. So right person for the job.
He's been very critical of Secretary Yellen in terms of when it comes to the front end and these bond auctions. Do you think he will push that out to longer dated debt?
If you go back a few years ago, when 10-year Treasury yields were where they were, 1%, everybody has to wonder, why didn't you take more advantage of that? Why didn't you do what mortgage borrowers did? But that's hindsight, and from here, I think the key is making sure that efforts are made to bring the deficit down. It'll probably be 7 to 8% next year, but bring it down. I think of the deficit as almost like a very high PE multiple on a stock. And the only way to keep markets calm about that is deliver growth. So that's why I think delivering growth and that 3% on real GDP growth is also an important part of that three-point strategy.
That three-point strategy, though, and you said that the one thing he don't think he's going to be able to accomplish is cutting the deficit by 3%. But he says by
down 3%.
Yeah, by 2028, though, if you were to get a deficit reduction by 2 to 3%, how long do you think it would take?
to get the deficit all the way down to 3% under the entitlements that we have, it's very unlikely. But let's...
Ever.
It's unlikely, in my view. If it's achieved over a handful of years or within the next 4 years,
David, what's
Dixon and Hamilton will go down in history as great Secretary of Treasury.
This administration's running 7% deficits at a time when unemployment's close to 4 and GDP is really robust. The idea that we can get down to 3 anytime soon is a worthy goal, but is it achievable?
Yeah, well, and this is the reason why people are skeptical of it. Whether someone's going to actually try to achieve it is also another question. What is your most contrarian call going into next year, given that a lot of the goals to reduce the deficit and also to keep growth at 3% seem unattainable?
Yeah, being contrarian or even being skeptical has not been very useful the past few years. So what I look for are where are good fundamentals still at a price that I won't bicker with. And I would say for the coming year that's still financials. I wouldn't bicker with those valuations, particularly for big banks. Healthcare is an area that I think has still been overlooked for a long time because of so much excitement in technology and digital, but very good earnings growth there, great long-term prospects, intangible assets, innovation, very on-demanding valuation. So healthcare, financials, and capital goods companies, that's what I like. So one of the things is that more oil, perhaps lower oil prices, but it's good for everything combustion, whether it's oil services or oil refiners, but also diesel engines, natural gas turbines, and jet engines, things like that.
Healthcare stocks have actually been down since the election because of some of the picks and some of the questions around how these departments are going to be overhauled. Do you lean into that at all, or do you basically see it as an opportunity?
We see it as an opportunity. I mean, the healthcare sector has generated really good earnings growth through bigger challenges than this, including already the negotiated drug prices. Now, we know that with a Republican sweep, they'll probably make some changes to some of these policies, but healthcare spending's going up, and the innovation that we see at most medicine makers and even medical device makers, we're encouraged with that, and the valuations are undemanding.
Hey, David, it's good to see you, and see you in person as well. Thank you. David Bianco there of DWS. Adrienne Yih of Barclays writing this. Gap is our top retail idea for a cyclical recovery into 2025 as it shifts from solidifying operations to growth mode. Adrienne joins us now for more. Welcome to the program. Let's start with Gap. Can you tell us what you think they're getting right at the moment? What's leading to this big share gain?
So what they're getting right is the value equation for the consumer. So if you look at the retailers that are sort of winning in this environment, it's those who are like Walmart, TJX, the off-pricers, Old Navy in this particular case. And they truly are kind of giving back real value to the consumer. With regard to the Gap brand within, the Gap organization, they're also finally starting to hit their stride on connecting with the consumer. So it's been at least a couple of decades, probably, last time that we saw them do positive comps at the Gap brand was 2011 and 12, when it was kind of the skinny leg craze. And I think part of it is that they're really focused on the fundamentals. They've solidified their store base, the cost basis. And we also, for lack of, other things, they also have a silhouette shift that is a denim-based one, and it's in their favor.
So you talk about creating value, and I think about the sort of pairing that idea, the lowest prices, with style and getting influencers to get wide-legged jeans that look like they're in vogue and get them out to the masses. What does value mean? Who isn't creating value?
Yeah, that's a great question, and we like to separate value versus cheap. So value is price paid for quality received. So when you go to an off-pricer, or even if you go to Old Navy, you think that you're getting, you're paying something, and you don't mind paying $50 for something that you think is probably worth more than that, $75 or $100 even in off-price. But what you do care about is paying, cheap prices for something that you think is worth exactly that or less, right? And that's the huge differentiator here especially in this environment where CPI, inflation across all these different products is eating away at that wallet. The consumer's really looking for somebody who's going to provide them the ability to stretch their dollar and stretch their wallet.
Adrienne, something that we woke up to this morning was suddenly a renewed focus on shipping costs and how that can come back to bite. And for an e-commerce type of organization, which a lot of these retailers seem to be coming, How important is minimizing shipping costs? How much is that becoming an increasing drag on some of the companies you cover?
So the e-commerce piece of it, exactly that last mile delivery, which you're talking about, we should think about those like wages. They just perpetually go up. Remember, the essence of kind of that shipping is going to be an employee base where their wages are going up, whether it's UPS or FedEx, et cetera, any of these delivery companies. So you can kind of think about that as a permanent inflator. And the way to combat that, frankly, because it's very much a variable expense, is to get ever smarter and ever better about your inventory management, trying to buy and see what demand is and sell at full price. So it's a really, really tough, equation there. But just as on their store side, the store payroll will permanently go up. It's just about operating your entire omni-channel business much more efficiently.
Adrienne, just wanted to finish on this. I know it's not a company under your coverage, so I won't name it by name. We'll just talk about the story in general terms. There's a company this morning where a single employee was responsible for small package delivery expense accounting, intentionally made these massive erroneous entries to hide about $150 million worth of expenses. How unusual is it for something like that to happen at a company like this?
It is, it's a breakdown of the disciplines. It is pretty unusual, frankly. Typically, let's put it into perspective that $150 million is on about $4.3 billion worth of total delivery expenses. So it's a number. It's a real number since 2021, but it's about 3% of their delivery expenses. Not a great look for, said company. But what I will say that there's a lot that goes on. I've been in the retail industry. That P&L has thousands of lines in it and thousands of employees that you have to assume are doing the right thing. And I think that there was a breakdown in this particular instance of the oversight in that department, for sure.
Adrienne, appreciate your views on that story as well. Thanks for being with us. Adrienne Yih there of Barclays. Noel joins us now for more. Noel, it's good to see you.
Good to see you.
Do you think that's the scenario we will be facing in 25?
I think so. I think there's, some euphoria. Obviously, we got the red wave. Everyone's looking to the positive parts of the policy. But we're going to get into a situation where, like I said, the Fed is easing into strength. You have these fiscal issues. Tariffs, I think, will be a big risk event. So I think those concerns come up in the first half of next year.
So what are you advocating for into next year?
Yeah, so I think I would probably take some risk off the table coming into next year. I also think the dollar will continue to grind higher. I think that it's sort of the U.S. will continue to be the cleanest dirty shirt. And I think we'll have probably lower global growth if we do get that tariff policy implemented.
This might be a dumb question. What is risk? What counts as that? Because some people are talking about risk in stocks. Other people are saying risk is in duration and the chance that maybe there isn't necessarily any kind of controlling force in the deficit and that you do end up, like Francis Donald said, with even rate hikes by the end of next year.
Yeah, so I think the biggest risk is in the long end of the curve. I think duration is that's what you want to focus on taking off. I think equities, they had a big rally. Right now, like I mentioned before, it's sort of what's not to like. But, when we get into next year, it's going to say what is there to like because you're going to have overvalued equities. You're going to have this fiscal concern moving into next year, and then you're going to have a Fed that's going to be forced to pause its policy.
So you're not buying the Besant bump?
I'm not. I think, again, I don't want to go against it in the short run. I think you kind of ride the wave. Maybe you get a Santa Claus rally. But once we get a little dose of reality into 2025, I think that's when you want to start to take some risk off.
You say tariffs are the biggest risk. Do you view tariffs, or do you think this administration will view tariffs as a negotiating tool to reset the playing field when it comes to free trade, or do you actually think they're going to use them as pay-fors for their tax cuts, which would then mean that the sequencing has to be in parallel?
I think it's the latter. I think the administration perceives tariffs as a way to pay for some of the tax cuts that are going to come through. But I think what they forget is that tariffs are going to go one way. It's either going to impact the consumer, so companies will pass the cost on, or it will put some pressure on corporate margins. goods. So I think that probably is a misguided sort of focus, but I do think their perception is that it'll pay for some of the tax cuts.
So if this is your base case, what does someone like Scott Bessent at the Treasury mean for that impulse that some other members of the administration might have when it comes to tariffs?
Yeah, so I think the initial reaction is that he's more of a pragmatist, but we have to realize that Trump won the popular vote. So I believe from his perspective, he thinks he has a mandate. And he, as he said before, his favorite word is tariff. So I think, Bessent, his perspective is he would like to ease things in, but I feel like Trump is going to want to implement that policy.
Are these tariffs a bigger problem for the rest of the world than they are the United States?
I don't think so. I think it's a problem for everyone because I think naturally you're going to get retaliatory reaction from other countries. I think when we look at the first administration, the retaliatory tariffs actually impacted the U.S. exporters disproportionately to the importers.
These were some of the farming producing states, agricultural commodities. They were the big focus then. Should we be focused on anything else?
I think because tariffs are across the board, I think everything should be a focus. I think it's going to be, a real different sort of scenario. We're at a very different starting point.
You're really expecting those blanket tariffs that have been promised on campaign trail. You think they could become reality?
I think so. He promised it. He won the popular vote. I believe, that's what he campaigned on. That's what kind of drove him into the White House. And I think he's going to continue to focus on that path.
So just to sort of put a bow on it or underscore what you're saying, is that the dose of reality that you think will really curtail what could be a Santa Claus rally in this melt-up?
I think so. I think, markets are sort of waiting for the clarity on that. I would augment that, obviously, with just the fiscal spending. We already have structural deficits. So all of that combined, that's something the Fed's going to have to focus on. And when they have to pause for that reason, it could cause some risk off.
Who's the biggest loser in a trade war?
I think the biggest loser probably, I would say, China initially, because their economy is already pretty weak. They've planned for it, I'm assuming, but they still are in a very vulnerable position. I would say outside of that, I think Europe is very vulnerable as well.
No, appreciate your time. Thank you, sir. Noel Dixon there of State Street.
Pleasure.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.